All right. Good morning, everyone, to this session today on central bank digital currencies. My name is Usman Mandeng. I'm with Accenture. We start with a short introduction by myself. We are missing one panelist, Cecilia Skingsley, from the Central Bank of Sweden, who unfortunately will not be able to make it. But of course, we do have a wonderful panel to discuss CBDC. So in my remarks, I'd like to sort of give you just a very, very brief overview of where we are with the adoption of central bank digital currencies. Now, Accenture is a leader in this field when it comes to CBDC solutions. CBDC promises to bring new functionality to central bank money. In fact, it could be argued it is a needed innovation to ensure that central bank money stays future-proof. Now, what is CBDC? The innovation with CBDC is the token format of central bank money. So you have central bank money in paper format and in reserves, and this would be a third format. The idea it should be or form an integral part of the monetary base. This is not about creating a new money. It is simply the same national currency, but in a different format. The idea is to serve token-based financial market infrastructures, and the dominant technology to administer tokens is blockchain or distributed ledger technologies. It is simply the best technology to manage these tokens. Dominant DLTs are, for example, R3 Corda, Hyperledger Fabric, and Quorum. Those are technologies that we work with in order to reach the needed sort of performance, privacy, and scalability that you need in order to operate in this space. Now, recent developments, there have been many, of course, include mostly proof of concepts by different central banks. We have worked with the Bank of Canada, for example, to prove that you can do a security settlement using a tokenized asset and a tokenized central bank money in order to perform these so-called atomic swaps, that is instantaneous settlement in token form. We've worked with the Bank of Canada and the Monetary Authority of Singapore to demonstrate that you can do DLT-based payments for payments swap in a cross-border environment. A very important development in Switzerland. We are advising Swiss Digital Exchange on establishing an entire token-based financial market infrastructure. Here the idea will be to be able to, in a fully regulated environment, to trade token-based assets. The Depository Trust and Clearing Corporation, DTCC, performed an important study in October, also with Accenture, to demonstrate the performance limits of DLT. And what is important here is to show that DLT can meet the performance requirement of peak US equity trading, with volumes reaching up to 6,300 trades per second, basically eliminating prior concerns that DLT simply may not have the performance and scalability needed for large value payments transactions. And then there's Sweden, that announced in June of 2019 a public tender for a retail CBDC. Let me dwell a little bit on Sweden because Cecilia is not here. So Sweden has a bit of a history regarding considerations for introducing CBDC in a retail format. The idea here is that in Sweden you see a very rapid decline in the use of physical cash. In fact, it's almost impossible to pay with cash in Sweden nowadays. Cash in percentage of brought money represents merely 1 to 2%. So cash has almost disappeared. The Riksbank, the Central Bank of Sweden, then was asking, should we withdraw from retail payments, or should we give a choice to citizens when it comes to being able to conduct transactions in central bank money? It seems to be opting for the latter. It launched a public tender in June. A number of companies have applied, and the idea is to start a broader test and proof of concept beginning of next year to see if retail CBDC could work. The motivation here is to replace cash, but it's also about the diversification of the payment system in Sweden. And then lastly, the People's Bank of China has announced that it is almost ready. Now, the Governor Yi yesterday clarified that no launch date has been set yet. Now, there are four critical themes that at least we are discussing with central banks. In the retail space, as I mentioned with regard to Sweden, it is to create greater diversification and resilience in payments. As you know, most payments, domestic payments, are conducted by the large network, the large card networks, Visa and MasterCard. Many central banks are motivated by the idea they want greater autonomy, they want greater diversification in the payment rails, also in particular in the event of extreme distress, to be able to allow their citizens to conduct transactions in central bank money. So diversification is a key theme. There is another theme, which is financial inclusion. Could central banks assume primary responsibility for the distribution of central bank money, of currency, effectively? That is obviously a motivation found in particular in emerging markets. Could CBDC become, given using mobile technologies, a way to disseminate and integrate into the formal financial economy those citizens that today do not have a bank account? In wholesale payments, the idea is very much to allow end-to-end settlements in token. Now, large value payment systems or any financial market infrastructure, it is an international recommendation that those financial market infrastructures should allow settlement in central bank money. So we are using this motivation to argue that central banks should be technology neutral, and where there are platforms that are conducting trading in token form, that the central bank should provide its currency for settlement in token form. So that's very much the motivation in the wholesale space. Then in international transactions, CBDC could allow to do things central bank money today cannot do. For example, it would allow, for the first time, to hold central bank money in digital form outside the central bank, including offshore. So this would allow, for example, a settlement in national currency in central bank money in a foreign country. It could bring new functionality and new possibilities to provide central bank liquidity for trading offshore. It could be a substitute for foreign exchange reserves. I think it may be able to address many of the issues and the deficiencies we have today in international monetary relations. And then there is the emergence of privately issued digital currencies, most famously Libra, of course, and I think it has given quite a bit of a jolt also to the official community. I think the idea is, could there be, in fact, coexistence of privately and officially issued currency? And if you take a very relaxed attitude about it, there's nothing a priori that suggests that private currency could be not as effective a medium of settlement as official currencies. This is a little bit of a new world, but not too new. In fact, historically, in the 19th century at least, a lot of currencies were issued by private banks of issues. Here in Spain, famously in the 19th century, the Bank of Spain competed locally with private banks of issues for the issuance of currency. Okay, so Libra, I think, has shaken the industry. There's a new thinking, and eventually, holders of Libra will ask themselves, am I better off fixing to my other Libra participants and floating against my national currency, or am I better off fixing to my national currency and floating against my Libra sort of participants? And the idea is very much we can rethink the whole idea of optimum currency areas, whether national boundaries or national territories are indeed the optimum currency sort of sphere of individuals or companies. All right, so I think what CBDC does, it has shifted or is shifting sort of what could be what are the success factors of national currencies. Now, currencies started very much in the 19th century of basically being metal or backed by precious metal, gold mostly, and silver. So the stability of the currency came from its intrinsic value. With the demonetization of gold and silver, the credibility or stability of the currency came very much from the quality of the issuer. Today it's the credibility of the central bank that lends stability to the currency. Now in the future, maybe it could be the functionality of that for a given central bank credibility, the functionality of the currency that could change the propensity or willingness to hold it. And I think that is the sort of world that CBDC could give us. So functionality of your currency, that may be the new success factor of people wanting to hold your currency in the future. All right, that's it for me. So we have a fantastic, really outstanding panel to discuss these issues. To my left, Yun Song Shin from the Bank for International Settlements. He's the head of research there. Jorge Ponce from the Central Bank of Uruguay, who is the head of research there. And Tobias Adrian, who is the financial counselor of the International Monetary Fund. Every participant has about, we have a little bit more time, but say 10, 12 minutes for presentation, and then we shall have a Q&A with the audience. The floor is yours.
Thank you, Sven. I'm just going to just wait for the slides to load. Well, first of all, let me thank the Bank of Spain for holding this really very good event and for their invitation. What I would like to do is to just set the stage in a fairly broad way and come back to some of the things that Usman mentioned, which was the role of central bank money in settlements, in particular for large value settlements, and then think about stable coins in that broader context. And it's worth going back in history and thinking about an early stable coin. So this is a picture of the Bank of Amsterdam, which was set up in 1609. And it had a very illustrious history. And it lasted for a very long time. It had a very successful role in the monetary system. And it was a stable coin in the way that we discuss stable coins these days. So what it does is take gold and silver deposits and then issue liabilities against those. And these deposits are used for settling financial instruments. So they are payment instruments in the way that they're actually used these days. And so it's not quite a central bank. There is no lending function, or at least there wasn't not meant to be any lending function, but it has the function of issuing money. And money is issued fully backed by gold. And in fact, if you remember Adam Smith's Wealth of Nations, he has a very long section on the workings of the Bank of Amsterdam, and he extols the virtue of this kind of arrangement, where because of the solid backing for the deposits of the Bank of Amsterdam, it actually had a premium over the gold coins themselves. So this is called the agio. In fact, the Bank of Amsterdam bank money traded at a premium to the gold because it's more convenient, because you don't need to test the gold coins, and it's a very, very convenient form of payment. And in fact, what he says in the Wealth of Nations is, at Amsterdam, however, no point of faith is better established than that for every guilder circulated as bank money, there is a corresponding guilder in gold or silver to be found in the treasure of the bank. So this is an archetypal stablecoin. Now, it had a very successful period from 1609 until the end of the 1700s. And during this period, it actually developed many more central bank-like functions. In particular, it took on some of the functions of what a modern central bank would do, which is to grant collateralized loans to some of the large market participants. So repos, for example. And in the crisis of 1763, which was a very serious crisis, and I have a paper on this with Isabel Schnabel a few years back. It actually played a very important role in quelling the crisis through issuing liquidity. Now, if you think about that, liquidity is provision of liquidity, the lend of last resort function. That is not compatible with what a stable coin is. Because a stable coin is a passive balance sheet where every unit of deposits have to be backed exactly by the gold that's backing it. Nevertheless, we know that the lend of last resort function of a central bank is extremely important, and that's especially also the case for settlement purposes, for the payments function. Now, the question then we have in front of us is, can a private institution, however solidly backed by gold, play the same role as a central bank? And what is the difference between a central bank and a private institution? Well, the main difference is governance, because the private institution, the private stable coin, is going to be run for the benefit of the people who are backing that venture. It may provide public goods, and indeed the Bank of Amsterdam deposits were indeed a public good, but it's a privately provided public good. And there's no reason why public goods should always be publicly provided. However, I think there is a lesson from the Bank of Amsterdam, because what happened is during the time when Adam Smith was writing in 1776, every guilder of deposits was fully backed by gold. So green here on the right-hand side, these are the liabilities, those are the deposits, and on the left-hand side in the assets, they were fully backed by metal. But what happened was, as the Dutch economy hit harder times and lending became more important. In fact, the lending was not allowed under the charter, but it was a private institution, and indeed some lending went on in small scale at first. But by 1783, you see this big red, which is the lending to the Dutch East India Company. And then there was also some lending to the Amsterdam city authorities. And you also see that the deposits are increasing, not because there was more gold being put in, but because there were more overdrafts being provided. So this is the beginnings of a lending function that was creeping in. But in 1795, there was a crisis, because what we see there is the blue bar shrinks. And on the right-hand side, we see a sharp drop in deposits. In other words, we have a run. We have a run because the depositors are now no longer confident that there is the gold coins that are there to fully back. And indeed, the Bank of Amsterdam could not recover from this and was shut down sometime afterwards. The modern central bank in the Netherlands, the Netherlands Bank, was set up several years after as a modern central bank. Some of the stable coins that were set up in the 17th century, of course, survived as modern central banks. And the Riksbank in Sweden is possibly the best case. And this is why they pride themselves as being the oldest central bank. But that survival, if you like, is very much a testament to the evolution of the role of the central bank. So if you're going to be providing credit in this way, the governance has to be something which is watertight. I think that's a lesson that we should bear in mind. Now, let me turn to settlement liquidity. So why is there such a demand for lending to support the payment system? Well, as you know, when you have a payment system with large values that need to be settled, the deposits that banks hold in the central bank are really too small to oil the wheels of large value payments. Because what would happen is, I would hold, let's say, $1 billion in the central bank, but I need to pay let's say, $2 billion. Well, then I would have to borrow $1 billion in order to make that payment. But it's not that there's going to be an imbalance. At the end of the day, everything will sort itself out. But during the day, there is a great deal of liquidity need. And here is a chart for the US RTGS system on Fedwire. It goes from 95 to the most recent period. It's the peak daylight overdraft in the Fedwire system. The red is in dollars, The blue line is the more interesting one. This is the one where we have scaled in terms of the total payments. And typically, before the QE program really kicked in, you would have about 1/10% of total payments during the day being granted as daylight overdrafts. So these are daylight overdrafts. They are repaid at the end of the day. It is there to oil the wheels of the wholesale payment system. And what we see now, of course, is that the daylight overdrafts, which is the vertical axis, the blue dots that hug the vertical axis, this was the period before the asset purchase program. On the horizontal axis, we're measuring excess reserves of the Federal Reserve. And what you see is when there were no excess reserves, daylight overdrafts were quite high. They're the blue dots, and they varied between about 0.8 to about 8 basis points to around 0.1% of the total value of payments. But as the Fed's balance sheet became larger and larger, as commercial banks held larger and larger deposits at the central bank, the need for daylight overdrafts fell. Now, if you like, this is one of the unintended benefits of QE, if you like. There were many other benefits from quelling the crisis, but what you see is that the payment system benefited from the additional excess reserves, and that the commercial banks did not feel the need to delay payments. And that shows up in the pattern of payments during the day. So here is a series of charts that show you what time in the day some proportion of the payments are actually made in Fedwire. So the blue line is the time of day when 25% of the daily payments were completed. That used to be that you had to wait until 2 o'clock in the afternoon before 25% of the payments were completed. And this is because if you're a bank, liquidity is scarce, you're waiting for others to pay you before you make the payments. So it becomes a coordination problem. The best outcome here is if everyone just pays up straight away without delay, so that we have a good equilibrium where we have the payment system functioning well. But there is a so there is a coordination game here where the banks are increasing their payments as a function of the incoming payments. But you see that as central banks, as the Fed's balance sheet became larger and there were much larger reserves, you see that payments are made earlier and earlier. And you see it also, the red line is when half the payments are made during the day. It used to be something around 4 o'clock in the afternoon, and that goes down to about 1 o'clock. So what is and this is my final slide, and I think it's worth thinking about the context of the discussions that we're having. And here it's worth distinguishing wholesale CBDC from retail CBDC. Retail CBDC, and Jorge will talk about this in a second, this is a way of granting access to the central bank's balance sheet to everyday users. But that's probably not the central case that many central banks are thinking about this particular kind of innovation. The cases that Usman mentioned earlier, the bulk of those cases are experiments in wholesale CBDC, where you're using CBDC to help oil the wheels of the wholesale payments and settled in central bank money. Now, if that's the use that you want to put CBDCs to, settlement liquidity looms very large in the list of desirables. And then, if that's the case, then you have to ask, can stablecoins really play the role of a settlement device when it has such an inflexible balance sheet? So either they stick to their governance rules, in which case it's probably not that useful, or they don't stick to their governance rules, in which case we have a problem. So either way, we have some fundamental thinking to do there. So let me just finish on that note.
Excellent. Thank you very much.
Okay. Good morning. Let me start by thanking the organizers, Banco de España, and the Reinventing Bretton Woods Committee for inviting Central Bank of Uruguay, and me in particular, here to Madrid to this very interesting conference and this beautiful place. It's always a pleasure to be here, and giving me the opportunity to share the experience of the Central Bank of Uruguay and my personal perspective in this issue of central bank digital currencies. I was asked to motivate a little bit the reasons why the Central Bank of Uruguay enters in this field, in this pilot about central bank digital currencies. So let me start by a very simple question, which is, will be central bank digital currencies the future? It's a very simple question, which a tough answer maybe. I don't know the answer. Only the time will tell us which is the answer for this question, but we can learn from past experiences. And for example, Kodak invented the digital camera and goes bankrupt. And why it goes bankrupt? Because it maintained the business model of providing paper-based picture photos and misunderstood the customer's needs and the experience that customers have from taking digital pictures. Nowadays, the number of leather and leather-like items sent worldwide in a year are more or less equal to the number of emails sent in a single day. So there is a digitalization process of all our activities. And information and communication technologies has developed and penetrated at a rapid speed. 20 years ago, we don't talk about Google, Facebook, so on and so forth, which are today the big tech companies. So the current technological trend is characterized by high-speed technological innovation and adoption of new technologies. It is a worldwide phenomenon. Other innovations like the deposits back in the Middle Ages was first in some part of the world and then it spread slowly and slowly, but today it's rapid and worldwide and demanded by customers. So it is maybe risky to continue doing things the same way as before in this new technological era, and I guess this is a motivation for analyzing these things. It is maybe safer to say that physical or paper-based money will be not the future, and it is already happening. Some cashless economies, and you refer to the case of Sweden, in other regions, decentralized payment like M-Pesa in Kenya, WeChat in China, and now the proposal of Libra by Facebook. Central banks are being challenged because payment system and the financial system as a whole are being challenged. The centralized digital payments system could entail significant risk and be severely tested in times of crisis of confidence, and how to secure price and even financial stability, even a safe payment system without good tools. And for central banks, cash is a tool to provide a payment system, for example. On the other hand, these new technologies could imply efficiency gains and provide advantages for central banks. For example, to provide stable and yet efficient digital payments to reduce the cost of cash. And in the case of Uruguay, it is not a cashless economy, but the contrary. There is too much cash in the economy. And if we estimate the cost of this cash is around 0.6% of GDP, but is mainly borne by the private sector, not by the central bank. So there is space to efficiency gains over there. Financial inclusion, security in payment, and enhances user experience could be other reasons. But we need to balance these efficiency gains in normal times against potential technological vulnerabilities and loss of confidence in stress time. Financial system and payments in particular are building trust. And trust is hard to construct and very easy to lose. Trust is a common good that central banks have succeeded to create and need to be preserved in some sense. Maybe this is another reason why doing nothing from the perspective of central banks seems not to be an option nowadays. In my opinion, central banks need to be proactive in order not to arrive too late to this new technological era and to be able to fulfill their mandates on behalf of society and to contribute to a healthy development of the financial system. But of course, the framework for central banking in this new technological era is complex, and one size does not fit all. There are fintech firms, telecom companies offering payment systems. There are banks holding the virtual monopoly of digital payment in cashless economy, like the case of Sweden. There are the high use of physical cash in most economies, like is the case of Uruguay. And despite the differences, a common objective for central bank is to build and preserve efficient and secure payment and settlement infrastructures. A sensible reaction is then to investigate new technologies in order to assess their pros and cons and to be ready to confront the challenge and to improve efficiency and security in payment and financial system. And for instance, in retail payments, some central banks are providing efficient digital payment system platforms, and this is the case of Costa Rica, for example. Others are analyzing CBDCs as alternative means of payment. So what has Central Bank of Uruguay done? In short, we issue, put in circulation, and test in the real world a CBDC called e-peso, and e-peso is the same Uruguayan peso but in digital. So we try to replicate the key features of physical cash, in particular to be legal tender and all the security stuff. The main objectives of this pilot were to test the technologies for central bank digital currency in a real-world experiment, yet controlled experiment, to visualize relevant issues for future analysis in the technological part, but also in the economic, monetary policy, financial stability issues, help to improve the design of this device, this central bank digital currency, but in a limit experiment in order to keep risk under control, limit in time, 6 months, in the issuance of the currency, in the limit of users, potential users, so on and so forth, and the case of use, mainly peer-to-peer and peer-to-business payment. And from the beginning in this pilot, banks were not involved in order to isolate the potential reputation and financial risks from the pilot from the rest of the financial system, in particular banks. It's a complex experience because there are many participants and it was necessary to outsource and coordinate with several participants. I will not stop here. I will go to the description of the e-peso system. So let me say first what e-peso system is not. It's not blockchain. It's not based on blockchain. It's proprietary software. And one reason for that is that it's not necessary blockchain because here there is a central authority with the certification device, which is the central bank, is based on the credibility of the central bank. Even though this could be implemented in blockchain, it's not a problem for that, and we are open to also to experiment with that technology. E-peso is like a hybrid between a purely token-based thing and a purely account-based thing. Because there is a token, which is the e-peso, but that token needs to be certified in the central system in order to be valid. So it's not end-to-end point thing, but there is no account. There is a vault in which the e-pesos are stored. So the core system has two components, a digital printer that issues the e-pesos and provides the security through cryptography. That improves security and prevents double spending and falsification. The second component of the core system is a digital vault that stores users' e-pesos and certifies the transactions. Here there are individual encrypted and anonymous vaults linked one-to-one to final users' digital wallets. This vault stores the e-pesos, verify and certify the transactions. There is instantaneous settlement. And here there is anonymity, but the transactions could be traced back. The information about the users is partitioned. Final users are not identified in the core system, but identification is possible because they are identified through the digital wallets and the SIM card of their mobile phones. So anonymity is guaranteed in general, and persecution of illegal activities, for example, anti-money laundering, financial terrorism, etc., is possible if required by a court of law or a competent authority. So this system improves security because the e-peso are safe in digital vaults even if users lost their mobile phones. And this core system is linked to the digital wallets of final users that manage the transactions. And during the pilot, this service was provided just by one company, which is an Uruguayan startup called InSwitch. InSwitch, through the application or in the mobile phone, identify final users, originate the transactions, and serve as the interface with final users. Involved in this pilot was also a telecom company that provides the telecommunication network, and something else, which is this is the technology which is embedded in the network of telecommunications, and this technology was used by the system to improve security. Because, for example, it was used to verify that a valid SIM card was existing. Also, to make a double verification of transactions. And it is possible to make transactions without internet connection using the code of this USSD technology, which is not a very good experience. You have to code with your keyboard, but you can make transactions anyway. And there were also Red Pagos, which has branches all around the country, and this was used to cash in, cash out physical pesos by digital ones. And the case of use were peer-to-peer transactions and peer-to-business transactions in registered stores that accept e-pesos as payment. So summarizing the main features of e-pesos, it is instantaneous settlement, requires just a mobile phone, not internet connection, but it works better with the internet connection. It's anonymous but traceable. The security is improved. And maybe the bad thing, but it's not too bad, is that unique bills, because each token is unique and with a specific denomination, could difficult exchangeability, but this is pretty easily solved by the core system because it makes change automatically and put in the vaults of final users the change of each transaction. So the experience was very positive. It develops according to expectation. Mainly peer-to-peer transactions were done. Around 80% of transactions were peer-to-peer. There were an increasing number of stores feeling it and receiving payment. Even at the end of the pilot, big surfaces like supermarkets approached to enter and to try to accept these e-pesos as a means of payment. And even banks were interested in offering their customers products linked to e-peso. So we think that is a potential for a prolific field for future innovation by banks and other fintechs, and there is potential to promote financial inclusion and security, transparency, and efficiency in payment systems. So after the pilot, we are evaluating the experience and considering future steps on that. It is crucial to evaluate potential impact, which in turn will depend on the design and parameterization of the system. For example, in the limits we can put to the wallet or the case of use, etc., etc. We are open to analyze other technologies and to evaluate other digital payment settlement infrastructure, because at the end of the day, the motivation is to have control of a payment infrastructure in order to be able to provide good services, even in the case of stress. And all these analyses and all these elements are relevant for the design of this infrastructure, CBDC or other kind of infrastructure. And in my opinion, the design of this scene should be as simple and transparent as possible in order to be successful, efficient, and also something we have to remember, to be demanded by the public and by consumers. So I stop here. Thank you very much.
Very good. Thank you very much, Jorge. And Tobias, please.
Good morning. Let me start you off with an important question. How are you going to pay for coffee? When you travel around the world today, you can pay for coffee with cash or with debit cards. But if you travel to China, you can pay with Alipay, or in many other countries with WeChat Pay. Elsewhere in the world, for example, in the US, you can pay with US dollar coins or with Gemini. We just heard the proposed currency Libra, which might be available all over the world. And another currency is Paxos Standard. So there's a variety, and this is just a very small sample of the possible forms of e-cash that is in existence today. There are many, many forms of e-money that exist around the world today. So how do we think about all of them? How do we classify them? What's the conceptual framework for all of this? So let me start off with a framework for how to think about digital monies. And this is what we call the money tree. So in the money tree, we distinguish by type, value, backstop, and technology. So let's get started with the traditional debit cards, checks, and wire transfers. So these are claims that have a fixed value. So if you use your debit card, if you use a check, you know exactly what the value is of your payment. And typically, those payments are backstopped by the government with a discount window, because this is done through commercial banks that have discount window access, and they typically have deposit insurance. Furthermore, it's a centralized system. New forms of cash and digital cash typically don't have the government backstop. So many of the currencies that I showed you in the former slide have a fixed value, but they have a private backstop. So this is what Hyun was referring to when he started off, talking about stable coins. And then there's a distinction between centralized and decentralized systems. So centralized systems are things like Alipay in China, where you have an account-based system, and WeChat Pay and M-Pesa in Kenya is like that. So these are account-based systems where payments go through a centralized node. And then there are the decentralized systems that Usman was talking about when he was talking about ledger systems. So for example, the US dollar coin is a distributed ledger technology that is a token that is completely decentralized and is based on DLT technology. In addition to that, there are forms of digital cash where the value is actually not guaranteed, where there are fluctuations in the value of your coin, and those are typically decentralized. So, for example, there are gold coins you can use today that are decentralized, and where the value of your currency fluctuates with the price of gold. And Libra is a proposal where actually the value of your currency is not fixed. It fluctuates with exchange rates, and it potentially fluctuates when interest rates are negative. So this is the money tree. So that's a conceptual framework to think about all of these different currencies. Now, what are stable coins? So what we think of as stable coins are decentralized forms of digital cash. So that would include things like the US dollar coin, where that's a stable coin that has reserves, where the reserves are held at a commercial bank. And then every single stable coin is backed by one of these dollar reserves at a commercial bank. Or it could be something like Libra or the gold coin, where basically the reserve is held in a basket of assets, such as an investment in a gold ETF or some sort of commercial paper and government paper in a reserve fund, and then the value of your coin is fluctuating with the value of the reserve fund. So that's stable coins. Now, do you think that stable coins are going to be adopted? So does it matter? So fine, there are perhaps a couple of thousand people out there that are using these stable coins, US dollar coins. I don't know anybody personally that uses them. I know one person. But is this going to be adopted? Who's using Bitcoin to pay for coffee? I don't know anybody. So is it going to be adopted? And so what we're thinking of here conceptually again is that, number one, you want stability of the store of value. So having a cash-like instrument that fluctuates in value might not be that useful. And secondly, you want to have attractiveness as a means of payment. So is this stable coin integrated into our digital lives, right? I mean, sure, we have cash, but the future is digital, and we want to pay digitally, right? We want to pay from cell phones, as we just heard in the case of Uruguay. So stable coins are not necessarily a stable store of value. And that's because there is a variety of risks, right? Stablecoins are a claim with a fixed value redemption that is privately backstopped. And so because it's a private backstop, there's counterparty credit risk, there's default risk, right? Like the company that you're interacting with might go bust. There's market risk in the case of things like a US dollar coin, things like a gold coin or Libra. There's potentially FX risk with Libra, and there's liquidity risk because the reserves might not be fully liquid. A variety of risks. Yet there's some adoption of these stable coins even today, because from the point of view of attractiveness of the means of payment, they're actually pretty good. They have low transaction costs, they have global reach, they're interoperable and have complementarity with today's technologies, and in some countries around the world, actually fintech companies are trusted more than banks. Furthermore, there's convenience. You can use your phone to pay with everything. You don't have to have a wallet and credit cards and all of this. Everything is done through your cell phone. There's one device that does it all. It connects with your friends. it calls to your family, and it pays for whatever you want to pay for. And of course, there are huge network externalities. And the network externalities is one of the main features that has come into the debate with the proposal of Libra. Now, I would argue they are not just private advantages. They're not only advantages potentially for you and me, they're also public advantages from a policy perspective. Number one, there's more competition. We like competition. Number two, there's potentially more efficiency because the new technologies are extremely cost efficient. Writing code, from what I hear, writing code to create a new currency is something like 2 or 3 lines based on the Ethereum technology. There's the potential for financial inclusion, which matters a great deal in the majority of countries around the world, where access to payments technologies, bank accounts, is still very low. And of course, there's innovation. We like innovation. As economists, as central bankers, as policymakers, we like innovation. Innovation is good. So cash is a very good store of value, but it's not that attractive as a means of payment. Deposits are more attractive as a means of payment because they are digital, and the usage of deposits is much larger than the usage of cash around the world. And then there are the stable coins, which are potentially more attractive, but for the moment are not as stable. So I talked a little bit about the private risks of stablecoins. So the risk of you as an end user of using stablecoins. Now, what are policy risks? So from a welfare point of view, what are risks of stablecoins? And there are many. So these are the big policy questions that central bankers are asking today. There's a risk of disintermediation. So it could be that deposits are going away from commercial bank deposits into stable coins, so that maturity transformation in the banking system is no longer conducted. There's the problem of market power. If a company like Facebook enters into the payment system with 2 billion users, it has a potentially huge market power that can be used in all kinds of ways. There's the consumer protection question. If, again, Facebook was operating Libra, it would suddenly get data on payments and could connect this data on payments with data on social network activity, and how that would be used is a big consumer protection question. There are monetary policy questions, particularly for countries with weak monetary systems. Dollarization, or rather stable coinization, might become much more prevalent and much more dangerous. It's much easier to adopt a digital currency in a country with a weak monetary system than to adopt cash transactions in dollars. So the potential for undermining monetary authority is tremendous. There are financial integrity questions that were already alluded to. Are these transactions traceable? And finally, there are financial stability questions, which is about run risk. So one of the striking things that we have seen since the Libra proposal, which only started 2 months ago, is that central banks are taking central bank digital currency a lot more serious today. So Uruguay was at the forefront, and Sweden were at the forefront of thinking about central bank digital currency already for a number of years. But with the Libra proposal, actually many more central banks around the world are thinking about central bank digital currency because they see the threat of the monetary system being undermined by private stablecoins. So what I want to talk about in my last couple of slides is about a proposal of synthetic central bank digital currency. So in our views, financial stability is at a crossroad. So you could go into one direction where you have stable coins that are regulated in one sense. So stable coins are created already. We heard that the private marketplace is generating hundreds and thousands of proposals for stable coins. And you can try to regulate a shadow banking system of stable coins. That's one way to go, and it's probably going to be a lost battle. There's the other way to go, which is to create what we call synthetic CBDC, which is to allow special purpose licenses where stable coins can hold reserves at the central bank, but where the central bank is not itself necessarily involved in the technology part, as we heard in the case of Uruguay. So this is a narrow banking proposal. So this is a proposal to grant special purpose licenses for banks. In Hong Kong, there is something like that called a virtual banking license. In Switzerland, there's a fintech license. The Bank of England is considering such a fintech license as well. And in India, there are payments banks. So narrow banks that could issue stable coins, that could operate a distributed ledger technology, all kinds of token-based technologies. It could be an account-based technology, but it would have the ability to hold the reserve with the central bank. That would be presumably a 100% reserve requirement. And so there are a host of advantages of such a narrow bank. It would ensure stability, because now you know that the stable coin that you're using is fully backed by reserves held with the central bank. So there wouldn't be the run risk that Hyun was talking about. It would be interoperable, because presumably the private operator of the stable coin would have incentives to have interoperability, and the narrow bank could be plugged into the RTGS, the real-time gross settlement system, whatever payment system is existing in the country. There would be regulatory clarity, because this would just be a banking license, so it would be regulated like a bank, but a very, very simple bank, because the very simple bank just has assets, which are reserves with the central bank, and liabilities, which are the tokens that are issued. It would rival the FX coin, so it would push back against the danger of the monetary system being undermined by the presence of US dollar stablecoins or Libra coins that could undermine monetary stability, and it would thus preserve monetary policy independence in your country. So basically, and this is my last slide, the central bank would do very little. So it wouldn't do as much as what we talked about in the Uruguayan proposal, where the central bank actually runs technology. Here, the central bank just grants a license, verifies that reserves are 100% backed for the stable coin, and that would generate the trust that is needed for the digital cash to be a true digital currency. And then everything else would be done by a fintech firm, or it could be a traditional bank, right? A traditional bank could have a stablecoin subsidiary that would be a simple segregated account that would just do one thing, hold reserves for the central bank, and then operate some form of tokenized payment system. It could be a telecom operator. It could be a startup. That doesn't matter so much. What matters is that the central bank just has to be in the business of doing what it's best, which is to grant a license for a bank and then verify that the bank is doing what it's supposed to do. So all the technology would be left, the innovation would be left up to the marketplace. Finding solutions would be left up to people like Usman. So this would be very, very close to really holding a central bank liability. So we call it a synthetic central bank digital currency, because you don't directly hold a central bank liability. There's still one balance sheet in the middle, which is the one of the narrow bank, But it's very, very close because all the narrow bank holes are central bank reserves on the asset side and stablecoin liabilities on the other side of the balance sheet. It's simple, it's cheap, and it's a private-public partnership, which we're generally keen on. So it's something very simple to do. It solves a policy problem, and it solves the problem that is currently in the marketplace, which is to generate stable coins that are really safe and really trustworthy is difficult. With a synthetic central bank digital currency, you would solve all of these problems. Thank you.
Okay, very good. Thank you very much. So we had, I think, a wonderful overview on some conceptual issues. I think he took us back a little bit to history. Stablecoins are not a new thing. In fact, indeed, the gold standard itself, paper money was backed by reserves in gold, and very much was like a stablecoin. Uruguay is the most important, one of the most important use cases. Sadly for me, it wasn't a blockchain-based approach, but nonetheless interesting. And I think Adrian brought up a very interesting case of this idea of synthetic CBDC. Can the central bank play a role more as a backstop, even though that's a dirty word when you come from the UK at the moment, but leave innovation to the private sector and offer the trust that the central bank can lend to the market in order to have an effective settlement medium. And I think maybe the USC coin, this consortium, comes very, very close to your proposal. Look, these are exciting topics. Let's open up the Q&A for the public. Please, are there microphones? So let's collect 2 or 3 questions and then allow the panel to sort of answer it. The gentleman, yeah.
Yes. Good morning. Just for full disclosure, I'm José María Orlán, chairman of the Spanish Banking Association. So my question is not going to be neutral or scientific, okay? I'm listening to you guys, and it's very interesting what you're saying, but there's for me something that is a little bit confusing. What are we talking about? Are we talking about replacing notes and coins? Or are we talking about replacing or creating something that is very close to bank deposits? If it is the first one, no problem whatsoever, There's so much competition in the payment system that is not anymore a source of banking profitability. In particular in Europe with PSD2, it's mission impossible to make money from the payment system. So that, it's fine. I mean, cash is very dirty, is very costly for the banks, and to create a more effective payment system, okay, that's fine. If we are talking about creating something that is very close to bank deposits, then, I start to have other type of financial stability concerns, because I think that in particular in stress times, that can be very close to bank deposits and safer. And then you can have a run on the bank deposits in the middle of a crisis. And going forward, if that is the case, who is going to give, who's going to finance the economy? Who's going to do maturity transformation?
Very good. The gentleman on the right there.
Good morning. I have to say that, the question that was just posed reinforces my thought that I think there is a lot of bias against digital currencies, both on the part of policymakers and on the part of issuers. I would refer back to history. In history, there has always been a clash between publicly issued currency and a privately issued currency in competition. And the latter, the private issuing, has always been the case. Even Bitcoin, it has come up. The problem is that at one point, competition and misgivings by issuers has created the need for public monopoly and fiat money. So the bias of policymakers is to think that inherently fiat money is more trustworthy than privately issued money. In Weimar's Republic, that was not the case. In many financial crises today, if you want to move out your deposits before capital controls, Libra or whatever is the best option you have. So this is the bias. There is a bias from banks. because they fear a lot about losing their delegated public monopoly, because the state and the central bank have delegated banks in exchange for supervision vis-à-vis banks. So I would take a more unbiased approach, and I think that the synthetic digital currency that was illustrated by Tobias could be a very good case in point, because the technology has changed. So now public monopoly is maybe not as efficient as a digital currency. Of course, the key point is trustworthiness. So there could also be privately issued currency which are publicly regulated.
Very good, thank you. The gentleman, the gentleman in the back that was first, yeah.
Hi, my name is Manuel Conte. I was a former director of Treasury in Spain. A distinction which I'm missing in the discussion as well as in the paper is between the old distinction between outside and inside money. And my claim is that industrial countries at least are never going to allow the emergence of a private outside money, because this goes to the core of the concept of money being a sovereign prerogative. And that's why I think Libra, to the extent that Libra is meant to be an outside money, even though there is some backing by a basket of currencies, is a Hayekian private currency. And my assumption is that the G20 or any countries are never going to allow parallel currencies together with the national currency. So in the US, it would be unthinkable that President Trump would allow an explosion of Libra as a general means of payment within the states. In Germany, exactly the same. So sovereign states are going to be always against parallel private currencies, in spite of Hayek's wishes years ago. And they are going to find measures to prevent that from evolving. And I think this distinction is key, because with inside money, that's fine. There has been throughout history many types of inside money, and it's a question of efficiency. But when it comes to outside money, creating a new currency, I think my guess is that countries are going never to allow the appearance of Hayekian new private currencies.
Very good. Let's allow the panel to respond, and then we have a second round, please. Who would like to start? Go ahead, please.
So let me start with the first concern, which is that, of course, the banking system is conducting maturity transformation, credit transformation, and liquidity transformation. And these are extremely important economic roles in the economy. And stable coins can potentially undermine, and central bank digital currency in particular, can potentially undermine this very important economic function. And of course, central bankers are very concerned about that. Any form of central bank digital currency should not undermine the commercial banking system and should not undermine this very important economic role. So I agree with the proposition that stable coins would probably be something very small. And so one important policy lever that I haven't talked about yet is what is the interest on reserve that a stable coin would earn, right? And this is anything from the interest on excess reserves, in which case it would be very similar to a bank deposit, to zero, or something negative, right? But the key thing here is that it's a policy variable, right? And so it could be zero, in which case it's very similar to cash. But in times of crisis, it could be turned negative. And when we're in a negative yield environment like we are in Europe today, actually being able to put negative interest rates on cash is something that is extremely appealing from a monetary economics perspective. So this is an added benefit, is that you could potentially put negative interest rates on cash. So that is number one. Number two is this question of inside versus outside money, and would authorities allow there to be private money? I mean, I think what Hyun illustrated is that when we look back in history,
private money creation is problematic because we need a lender of last resort, which is why central banks were created, why the Bank of Spain was transformed from a private bank into a public institution. We need the lender of last resort, number one. And number two, it has to be that somebody is responsible for overall money supply, right? And that is what Friedman and Schwartz is teaching us, right? So even if there are private monies to some extent, still some institution has to make sure that overall money supply, taking into account the supply of these private monies, is appropriate in order to ensure price stability, right? So these are two very important roles for the central bank. And let me just add here that in many countries, money market mutual funds have existed for decades and have been a very close substitute to money. And so we have been living with private monies, or something very, very close to private monies, for a very long time. And in some jurisdictions, these private forms of monies are quantitatively large, right? So in that sense, it's actually nothing new. You know, the design, how to frame policy around stablecoins is really important because there are dangers. There are financial stability dangers, there are disintermediation dangers, and there are, of course, these international capital flow dangers that we can elaborate on further as well.
Very good, very good. Maybe for the benefit of the audience, just to clarify, indeed, most monies today are private. Right? So when we talk about currencies, it's a very small subset of money, only typically in the euro system about 10% of bought money. Most money already is private. Jorge, please.
Yes, thank you for the questions, and I agree with Tobias in the sense that it's very important to preserve the good things of financial intermediation, and we in particular in Uruguay are very concerned about that, about the effects of digital currencies on bank de-intermediation or in bank intermediation. And of course, the pilot of e-peso was not account-based. So it's a token which is that operates through this system I described. So in that sense, again, the design of the thing is very important. And the design of the thing could put some limits to the wallets, because the final objective of e-peso is to serve as another representation of the Uruguayan peso as cash. So in your wallet, in general, you have a limited amount of cash in order to pay transactions in day-to-day basis or something else. So the same idea could be replicated to the limit on the digital wallets in order not to de-intermediate in some sense. Since it's not account-based, it's not will not pay interest, even negative interest. So in that sense, banks will still reach a new equilibrium in which they use and offer these e-peso link products to customers and make business over there. So there is a balancing between challenge and opportunities for the central bank, but also for the industry in the case of Uruguay. Related to the synthetic central bank digital currency, I like the idea. I personally like the idea. In particular, in Uruguay, I guess in other jurisdictions, there are something similar to that. There are limited licenses to electronic money providers. But the thing is that they are good, they innovate, they are private owned with all the stuff. But what happens in the worst case scenario? What happens in a time of crisis? This is the acid test as a central bank we should take care of. So to preserve the basic payment infrastructure is very important. And I am not sure, I'm not completely sure that the design, the actual design at least, of these electronic money providers guarantee the infrastructure in the case of crisis. And this is a concern for a central bank, a concern that is long in history from the creation of lending of last resort. It's just that, it's just to provide liquidity through the channels. So the main channel was cash, but in the digital era should be another representation of cash or another representation of the channel, the infrastructure. So this is the main concern from my point of view as a central banker.
I think it's, so I spent my presentation talking about the wholesale payment system, which is about the payment system rather than money as such, although I think they're very closely related. But let me say a few words on the retail side, since most of the discussion so far and the questions have focused on the retail side. Now, money is already digital.
Yeah.
If you use your debit card, if you use your phone app, it is not actually someone writing in a ledger longhand. It is actually digital. It is actually digital. If you look at Sweden, they have a payment app called Swish. The look and feel of that is exactly like what you would expect with any other phone app. It's very convenient, but that's a bank-based system. Now, why is it that we have a lot of discussion on retail innovation? I think the primary reason is that there is still dissatisfaction with the cost and the speed, especially for cross-border payments. I think it's fair to say that in terms of retail payments, most of the huge advances that we have seen in the last decades have been in the user experience. It's in the domestic payment system, as opposed to the cross-border. And as Tobias said, I think there is still a long way to go, especially in developing countries, in financial inclusion, in bringing those people who are excluded from financial services into the benefits of financial services. Now, what are the impediments to that? So one type of impediment is the basic issue of how do I know that you are who you say you are? So digital identity. That's a kind of very basic type of issue. And there are ways of solving that problem, although there are debates about privacy and so on. There are biometric ways of establishing digital identity. In India, they've made huge strides in enrolling the bulk of the population in their digital ID program called Aadhaar, which is where you take the facial recognition, fingerprints, and so on, and then build layer after layer payment systems on that. Now, these are all domestic. These are advances in the domestic system. The key point still comes, how do you link up payment systems across countries? And this is where the current account-based system really comes up to its limits, because if you have a payment system in one country, it's underpinned by the central bank. Although Usman says most money is private, that's only half true, in that money is indeed deposits of commercial banks, but it's underpinned by the central bank. So in that sense, it's not a purely private money. It is underpinned by central bank money. But how do you link up payment systems across two countries? And this is where the current account-based system really comes up to its limits, because then the quickest way would be just merge the two RTGS systems. And that would be like saying, if I'm a bank in Spain, I could have access to the central bank where I will send my central bank in the jurisdiction where the recipient lives. And that, of course, is a huge step which cannot be undertaken easily, not least because someone has to check who these people are, and you don't want whole departments of the central bank checking on know your customer rules. So you have to sort of trace where the money comes from. Is this a genuine payment? Is this actually illegal activity, and so on? Typically, those checks, the KYC checks, know your customer checks, are done by commercial banks. And That division of labor has served very well, certainly in domestic payments. But again, it's the cross-border element where we come to the limits of the current account-based system. Because what you need to do is to find a chain of balance sheets. So if I want to send my money to another country, to a recipient in another country, I need to find a chain of balance sheets where at each step, both the sender and the receiver hold deposits in that bank. And then ultimately, the money is credited to the account of the recipient. As Usman was explaining earlier, these digital tokens are a leap in that respect, because what happens is they are transferred peer-to-peer. So you don't need to go through a balance sheet. You can just look up the list and say, yes, here is this bank, which is the bank of my friend that I want to send money to, and I will just instruct my bank to send a token. You don't have to go through the chain of balance sheets. This doesn't mean that you can forget KYC. You still have to do the KYC. You still have to do the checks. And it does mean that, though, that you are reducing the steps. However, someone has to be running that whole network. So it has to be a network of banks that are members of the system. And so, when we see this kind of system, it's just the virtue of sending the tokens is not going to solve that problem. Now, if we were to expand the e-peso example globally, what we'd need to do is to have a telco, a telecoms company, which would do all the KYC, and then there'll be one telecoms company who could do that. So in a way, the KYC is being done through the telco rather than through the commercial bank. So I think there are many architectural issues, but the one killer app is the cross-border payments, and this is where the token really comes into its own. So I think when we look at this from a policy perspective, we have to be very clear-sighted as to what are the technical breakthroughs, but what are the institutional backdoor work that needs to be done, the backroom work that needs to be done in order to make that system work. And I think the synthetic CBDC idea, I think, is very promising, the way that Tobias described it. But what he showed is only a very narrow slice of many things that are going to have to put in place behind that slide. So I think this is where we have to be literate about the technology, so that when we approach these issues, we can address what is feasible, but then not be glossing over some very hard institutional questions that have to be put in place. So this is a critical public infrastructure, and we shouldn't be playing games purely for the sake of experimentation. We have to be absolutely sure that whatever steps we take is for the public good. And this is especially, I think, the case for the payment system. So let me just stop there. Maybe we can have another round. Do we have another round?
Do we have another round? Excellent. I'd just like to just one reaction on the sovereign versus private, and I think it is of course a fair point, and I'd like you to think not only living here in the euro system, where indeed you may be content in using your currency, but most countries in the world have a very turbulent monetary history. There, the propensity to look for something else, where the fiat money is not necessarily the trusted standard. I think it is something that in this whole debate, please do keep in mind. Europe, the United States are not necessarily good references when it comes to thinking about.
The answer to that is we should have the proper public infrastructure there as well. So we should have a credible currency to begin with.
But it's just, I think, the propensity to sort of think beyond official currencies, you see, I think is there is a driver there that I think you can justify by the mere fact that fiat has not always proven to be the trusted standard.
Yes, but what I'm saying is, yes, that's that is a typical tendency we see, but the prescription there is to fix the system, I would say.
Fair enough. Yeah. Fair enough. And looking at the complementarity, which could well be in the cross-border space rather than in national payment system. Okay, so we have a second round. We had already three logged questions, I'm afraid, here on the Alicia, the first, Jean-Pierre, and then the gentleman over there. So the first is the gentleman there. Yeah, please.
So, thank you very much. I'm Galo Nuño from the Banco de Spain. My question builds on the first question and especially on the reply that Tobias gave. So it's about the implication that this central bank digital currency has for the balance sheet of the central bank and the conduct of monetary policy. First, as Tobias has correctly, in my opinion, underlined, the introduction of central bank digital currency would imply the implicit or explicit introduction of an additional interest rate that would be the interest rate that can be zero of this CBDC. And depending on the gap between that interest rate and the standard deposits rate, I mean the typical policy rates, the health of the banking system would be improved or deteriorated, meaning that it will control the degree of competition between the CBDC and the standard bank deposits. So I don't know, I mean, somehow it reminds me to this overnight reverse repo rate of the US. So I don't know if this is the kind of thing that you have in mind and how would be an appropriate way to conduct monetary policy in that environment. And conversely, and in the introduction of CBDC implies, if it's successful from the point of view of the central bank, and the introduction of a new liability, that it will imply the introduction of a new asset. So I don't know if that's necessarily implies an increase in the size of the asset side of the central bank. And there is this very recent proposal by Markus Brunnemeyer and Dirk Nippel that what the central banks should do with this new asset is to reinvest it into the banking system in order to avoid all these kind of panics that the first question was referring to. So I don't know if you can develop a little bit on this proposal, I mean on those 2 points about the way to manage the assets and the way of control policy rates in such an environment. Thank you.
Okay, very good. So with Alicia here in the front. No.
Well, first, congratulations. It's really a very interesting panel. I have a question basically linking Hyunson's point on the cross-border consequences of what we're talking about and the synthetic central bank digital currency. And it's very simple. It's what will central banks do if they happen to have a central bank currency, not yet synthetic? If we manage to go there, it would be easier. You can basically impose reserve requirements. I'm thinking about dollarization, yeah? I mean, once upon a time, how would central banks reduce dollarization? Imposing higher reserve requirements. So you would have to have very negative, maybe, rates on, interest rates on your reserve requirements, on your synthetic digital currency. But the thing is, it would be issued by another central bank. Meaning you would have to treat these digital currencies unequally with the consequences that this may have. And is that something that would happen? You know, think about renminbi, think about Thailand, think about the Bank of Thailand, maybe not anymore here, could do about that either. Because literally its bad monetary base may disappear otherwise. So, you know, I'm just thinking, synthetic is of course one of the solutions, but you need to take very bold measures on taxing that e-currency to get your way. So can you do that?
Maybe we can get Jean-Pierre Lando.
Let's go to the last, Jean-Pierre at the back, at the left.
Yeah, maybe some comments which are triggered by the first round of questions and remarks. Clearly, there is a concern that people don't want private entities to issue outside money or new unit of accounts. And I think the central banks and the authorities can kill that. They can prevent that if they want. They can kill Libra tomorrow if they want. So I'm not worried about the power of sovereign authorities to prevent unwanted monetary private initiative. The question is whether they can do that without repressing technology and technological progress and progress in payments. So there's a tension between those two objectives. Preserving the autonomy of monetary policy and the unit of account and outside money on the one hand, and on the other hand, letting new forms of money flourish because that's what people want, as has been said. And they want it for many reasons. I think Hyun said about the cross-border, yes. And also, even in domestic payments, if you make an experiment, I have lunch with you, I can pay the lunch with my credit card, but then we want to share the bill. We cannot share the bill with our credit card. We can share the bill with our mobile, and tokens on our mobile. So the mobile money with the token, which is attached to it, is much more flexible in terms of payments than any existing, however fast they are, existing means of payment. That's where we're going, and that's what people want. And one of the most, I think, strong argument that you can hear is, how can I come send an email to my girlfriend who is in Japan, and I cannot send you $20, you are across the room. Right? So that is the problem that payments people have to face. And I subscribe totally to what Hyun has said, but on the other hand, it still reasons in a framework when you have what he said, a chain work of balance sheet, right? But what Libra brings is precisely very different. It's a network with tokens moving on that network. It needs an infrastructure, but it doesn't need balance sheet. It doesn't need claim on a financial intermediary. That's why it goes so fast, and that's why it's so flexible. So the question, I think, is how do we move towards that, network plus token, as compared to a counterparty relationship between banks? And I think if the authorities want to consider both those objectives, accept that technological progress, and still keep their monetary sovereignty, that is the case for having a CBDC. It's a very strong case for having a CBDC, including in retail. And that's why what the Uruguayan experiment is extremely interesting, because I think they have internalized that as they interpret it. Now, the question is why the big central banks seem to be a little bit sort of reluctant to go that way. And I think that they are too optimistic about the prospect for cash in the future. Cash is still very dominant. Cash is still very important. But there may be discontinuity. At some time, the cash use may drop. That's why I asked the question to the governor of the Bank of China yesterday, because it's dropping dramatically in some Chinese city. So it would be very careful to prepare for that.
Okay, very good. I think one aspect here we need to distinguish between functionalities, how can you send money, which you can do in central bank money or in bank money, and one is the central bank money itself as a medium of settlement. I think these are two different sort of concerns. A little question there, and then we give it back to the gentleman over there, and then we give it back.
Thank you. Fernando Fernandez, a professor at the EA Business School. Just a quick question to Tobias on the e-currency, because we tend to forget about the bad times. And the problem is that one of the problems with private money is that crisis happens, and at some times you don't only need the lender of last resort and the money supply control, you also need deposit insurance. So are central banks willing to extend the deposit insurance coverage to the e-money or the synthetic e-money? Because that's the big issue. And if they do, then it's just bank money. There's no difference. And then the fintechs or the issuers of these stable coins will become banks for all practical purposes.
Okay, very good. Thank you. So let's, Samuel, as before, Tobias, would you like to start?
Yeah, I'm happy to start. So let me just make a big picture remark. So the IMF and the World Bank released the Bali FinTech agenda last year that made the point that with these new technologies, you really want to take a balanced approach. As was pointed out, one impulse of authorities is to forbid everything. Another impulse is to allow everything. And probably the optimum is somewhere in between. You do want to take advantage of the benefits of new technologies, but it does come with risks. And having a balanced approach is really key here. And this is where the devil is in the detail. I mean, really thinking through all of the implications and all of the details of these proposals is tremendously important. I did want to point out that the FATF, the Financial Action Task Force, has released guidelines for dealing with the Know Your Customer, AML, CFT, so anti-money laundering, terrorist financing issues that were raised. And in principle, every country around the world has signed up to these principles, except for one or two jurisdictions that you probably can imagine. Those principles, if they are followed, and of course there has to be an authority that makes sure that the principles are followed, but those are in principle taking care of the KYC issues in the digital cash domain, right? So how to do that, how exactly to implement them is an operational question, but it is something that I believe can be solved. In terms of the conduct of monetary policy, of course, there's the question of whether you operate a floor system or a corridor system, so whether you have excess liquidity or scarce liquidity, and that interacts with the question of whether you want to pay interest on reserves on these interest on these stablecoin reserves in this synthetic central bank digital money proposal. In principle, if you operate a floor system, in principle, you could pay interest on reserves, and some financial economists have actually, or banking economists have actually argued for that. So there's a debate going on, and if you did pay interest on reserves, at that point, the Brunner-Meyer-Nieper proposal of reinvesting these central bank reserves in the private banking system would be one way to address the concerns that were issued earlier, that there's the potential for disintermediation of the commercial banking system. So, I think this is a whole topic for another panel, and it gets pretty deep pretty quickly. I did want to just finish with one thought about the dollarization question. So, on the one hand, stablecoins have the tremendous potential to undermine the monetary authority of countries. But on the other hand, central bank digital currency is a way that countries are actively thinking about to counteract dollarization. Because there the argument is that, well, we want to get rid of dollarization. CBDC, whether it's synthetic CBDC or CBDC run by the central bank, can actually be helpful to establish a monetary framework and a domestic payment system that operates better than the dollarized system. So I think there again the devil is in the details. So how exactly you implement this system, CBDC can be helpful in counteracting dollarization and the undermining of your domestic payment system and monetary system.
Thank you. Jorge, would you like to?
Yeah. Regarding monetary policy, the management of monetary policy is being challenged in general by digitalization. The velocity of circulation of money, as we said, there is electronic money, there is digital money, and this is being challenged. So let me refer to the case of Uruguay and the proposal of e-peso. E-peso will not make that worse, in the sense that, there could be effects on the multiplier, velocity of circulation, so on and so forth, but on the other hand, we at the central bank will have real-time information about transactions that nowadays we have not. We have aggregate and we delay information. So there are pros and cons on that. Regarding the substitution of the digital currency via deposits, that is possible, but again, it depends on the design and the particular parameterization of the system, as the prevention of anti-money laundering, so on and so forth, know your customer, all this stuff should be embedded over there. Regarding cross-border, of course, the e-peso does not pretend to be an international money, international currency, just want to serve the service inside Uruguay as the Uruguayan peso. Uruguayan peso is not as appealing as a reserve currency. But there are things related with tourism, for example, foreigners coming to the country and how to operate, and these are technical things we are thinking out because tourism is very important in our region. And regarding the question of the coverage of the deposit insurer, let me say how it works in Uruguay with these electronic money providers. These electronic money providers are some kind of a narrow bank which needs to make reserves in bank deposits. So they are covered in the sense that their reserves are in bank deposits, so they are covered by the deposit insurer.
Thank you. Ewan?
I think this discussion has been very, very helpful, and I think in general the increased attention now being paid to the nature of money, nature of the payment system, has really served a very important purpose of shining a spotlight on some of the existing frictions that we have in the current infrastructure. And I think we, in the policy community, should redouble our efforts to eliminate many of those inefficiencies. I think it's fair to say that the advances in the payment system we have seen in the last few decades has very much been on the user-facing part. It's the front end. It's the fact that now you can use your phone. It's now that it's much quicker with the fast payment system. But the back end, especially on the cross-border settlement, has really barely changed over the last few decades. I think this is where especially in the central bank community, because ultimately the payment is done through central bank money and settled in central bank money, that this is where the central banks will have to come in a big way. I think the technology definitely adds a new element to the discussion, especially the ability to transfer tokens peer-to-peer, rather than having to go through the balance sheet chain. But even here, I think we have to be, perhaps from now on, from the very beginning, to start to think about what would be the institutional backing that would actually make such a system work. Unless it's an open, permissionless system like Bitcoin, which is where anyone can join and trade these tokens. Typically, the cases that we've examined, the cases that Usman mentioned as having undergone experimentation by central banks, have been permission systems, where it's really just like central bank money, but it's in digital form, and it's traded peer-to-peer. So if we were to think about a global analog of that, we have to ask questions like, who would be a member of that kind of network? Who's going to decide whether a particular bank or payments firm is going to be a member? And who's going to vet, who's going to ensure the KYC requirements that Tobias mentioned? So I think in terms of the policy work, we should be working in parallel tracks where we explore ways to improve the current system, and there's plenty of scope to do that, as well as to think of how to set up the institutional backing that could, if needed, or if there is a demand, can serve a new system based on a token currency. And as always, we should look back and just learn the lessons of history and try to separate out what's really useful from what is just hype. And I think as policymakers, we owe it to our constituents to actually do that.
Very good. Fantastic. So let's conclude. I think we learned that we have the technology to do something new with central bank money, but the governance and institutional framework obviously are key in order to allow for an orderly integration of these new possibilities into our national and also in particular international payments relations. I would like to thank the Bank of Spain very much and Reinventing Bretton Woods Committee for organizing this conference. It's certainly been my pleasure. Let's conclude and have a coffee break. Thank you.